We're going to calculate the stock price for Williams-Sonoma using prior financial information. First step is we need the market cap, which is 6.5 billion. Next we need the stock price, which is 83.67. And that means they have 78 million shares outstanding. The way to calculate that is you take the market cap and divide the stock price. Next, we need free cash flow, and that can be found in the financial section on the cash flow statement. And the best way to calculate the stock price for a company is to estimate future free cash flow and discount those numbers back to today's dollars. And that's what we're doing in today's video. Next, we need net income, which can be found on the income statement. And that's how much profit a company has made in a given year. Next, we need revenue, which are the sales for each year. And they look pretty consistent. And that's what you need in a DCF model, consistency. If the numbers are all over the place, you won't get a good valuation. Now we need to look at the capital structure of Williams-Sonoma and figure out the discount rate we need to apply to the future cash flows. So there's no interest expense in Yahoo. So we have to go to the 10K, and I have it all set up. This is the income statement for Williams-Sonoma, and their interest income for 2019 is 8,853, which is $8.9 million. Now let's look at how much debt they have, which can be found in the balance sheet in the liability section. And the current debt is $299 million, and they don't have any long-term debt. So all the debt is due within 12 months. So they pay 3% interest on the debt. Interest payments are tax deductible, so we need to find the effective tax rate to reduce the debt. So income before tax, $457 million. That could be found in the income statement. And income tax expense, also on the income statement, $100 million. So the cost of debt is 2.3%. Now we need the cost of equity. And we need to find the beta, which is the volatility of the stock. And that's 1.57. So it moves about 1.5 times the market. And 13.85% is the price Williams-Sonoma pays to obtain financing. So Williams-Sonoma needs to generate at least 13.85% profit a year to add value to its investors. And that's the weighted average cost of capital, and that's what we're going to discount the future cash flows by. And we calculated the future cash flows for 4 years. Then we did a terminal value using the Gordon growth model. Then we discounted those numbers back to today, and the value of the company is $3.9 billion. And if we divide that by 78 million shares, we get an intrinsic value of the stock of $51, even though it's trading at $84. So it's trading at a 65% premium, so we consider this a sell, according to the model. And this is the historical stock price for Williams-Sonoma. And let's see if it ever hit 50. It looks like it was trading... This is 50 around here. It was trading at intrinsic maybe a couple weeks ago, but it's come back up. It's actually trading, it looks like almost at its all-time high. So stocks can trade higher or lower than intrinsic value. The stock price is predicated on supply and demand of the market. If more people want to buy the stock, the price goes up. If more people want to sell the stock, the price goes down. So you can do your research, and you'll see some analysts will say, buy Williams-Sonoma, and then others will say, sell Williams-Sonoma. But each analyst uses their own model and their own unique assumptions. But you will never see their model. This is my model and my opinion. So I hope you liked the video, and thanks for watching.